This is the last chapter. You'll find 21 and 22 are a little bit more straightforward than chapter 20. So we're kind of on the downhill slide there. Just to kind of give you an overview of chapter 21, kind of a reference. First, we're going to look at accounting changes in policy, which we adjust retrospectively. We're going to talk about changes in estimates, which we adjust prospectively. And we're going to talk about corrections of errors, and those are retrospective. So that's going to pretty much sum up the chapter. In chapter 4 and 8 in Accounting 315, at least I think those are the chapters, you did the same kind of thing with this. So we're just expanding it now to include all the new stuff you've learned in between. So, chapter 21, including Appendix 21A, which you have to know, deals with accounting changes and error analysis, which has been covered in 315. But we're just expanding it, plus we're putting in future income tax because you didn't know that in 315. You do know it now. Make sure with Appendix 21A you go through the examples. With this chapter, because an error could happen literally in anything you're doing in the accounting process, the more questions you try, the more prepared you'll be for the final and for real life practice. So just kind of bear that in mind. Unlike, something where I can only, I'm going to ask you, they issued the bonds, they did this, here's the interest date, where it's kind of a set question. These can come from anywhere. So the more questions you do, the better. Okay, let's just jump right into the chapter. So part A is talking about accounting changes. So change in accounting policy, change in accounting estimate, correction of error from prior periods. Because obviously, if it was in the current period, it would just fix it now. You can find it later. That's the problem. Now, with the change in accounting policy, it can be voluntary or involuntary. So, involuntary is when the standard changes usually. So, for example, with the new marking assets to fair value, the new standard came in, the IFRS 9, and you had to change to it. That would be an example of an involuntary standard change. So first what we'll do is give you just kind of an overview of what a change in accounting policy is, and all these three things are, how to deal with them, what retrospective, prospective mean, and then we'll start going through some examples. So a change in accounting policy is the change in the choice of specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. So under IFRS, a change in accounting policy is only permitted when the change is required by a primary source of GAAP, so IFRS, or, and this is key, results in portraying reliable and more relevant information. So if you see wording, and in particular, more reliable or more relevant, then you know it's probably accounted for as a change in accounting policy, because sometimes it's not. Under ASPE, there's a third type of policy change permitted, voluntary. Between or among allowed ASPE accounting options, investments in subsidiaries, you're going to do that in Accounting 410 if you go on. Development phase expenditures on internally generated assets, so either you're going to expense or capitalize. Defined benefit plans, of course, our pensions. Income taxes, you're going to either use taxes payable approach or future income tax. And measuring equity components of certain financial instruments. So that was chapter 16. That was, remember, you bifurcate it and you could have measured the debt first, then the equity, or you could just say the equity was 0. Now, it's important to note that for the purposes of making changes, a change in accounting policy does not result from the adoption of a different policy necessitated by events or transactions clearly different in substance from those previously occurring. So a change in the pattern benefits. So if you change an accounting policy because something underlying has changed, then that's okay, right? Remember, way back, probably in intro, we talked about you can't flip-flop between accounting policies just whenever you feel. You have to have a reason for doing it. Here is pretty specific when you can do it. But if something changes underneath and a change of pattern of benefits or an underlying change, then you don't need to worry about trying to follow this rule. This will actually be a change in estimates. Or treat it as a change in estimates. And remember, you guys, that delta is change, like we've been using. Also, if there's a new policy, recognizes events that have occurred for the first time or that were material. So example, let's say you didn't sell to your customers on credit. In that case, you don't need to do bad debt and AFDA adjustment every year or quarter or whenever you're doing financial statements. So, sorry, just want to write that down. So instead of that, if all of a sudden you started granting credit, so then you decided to implement bad debt assessment using the balance sheet approach, whatever, that would be a change in estimate when you institute it. So if you suddenly, or if you started granting credit and adopt the balance sheet approach of bad debts, then it's a change in estimate. Not a change in accounting policy. And it's going to be treated differently. So the big deal with this is here. With a change in accounting policy, you do retrospectively. So you go back and fix or restate things in the past so investors can compare over time. With a change in estimate, because you're acting with new information, you don't go back and fix it or change it. You just go from here forward. Okay? So again, you've talked about this in 15. Hopefully it'll all start coming back to you. Okay. So on page 2, some specific situations that are not changes in accounting policy, like the one I did. Adopting interest capitalization during construction of own long-term assets when they had not previously been involved. So new. So this would be change in estimate. Deferral of development expenditures where previously they were expensed because they were immaterial. Now it's new. So again, change in estimate for both of those. And basically, when you do accounting policy, because underlying conditions have changed, you don't go retrospectively. So you don't call it a change in a policy. You say, oh, it's a change in estimate. I do it prospectively. So that means it will be prospective. Okay, Okay, now, changes in accounting estimates besides the ones we already mentioned. Adjustment based on a change in circumstances on which a previous estimate was based, or new information like we set up there. More experience, subsequent developments. Whenever we estimate something, of course, think of the estimates that go into depreciation, right? The residual value, the estimated life, exercise of judgment. You could estimate a building or a piece of machinery is going to last you for 200,000 units. Well, it turns out it's going to last you for 400,000, better than you thought. You're going to change your estimate. So, some examples of items requiring a change in estimate: litigation accruals, R&D estimates of costs, obviously depreciation, bad debts, because remember we're using estimate percentages, warranty expense, FIT asset or liability, and so on. There's literally hundreds of these that we've made. So, differentiating between a change in policy, which would be retrospective, and a change in estimate, which would be prospective, can be difficult. So, is a change in amortization a change in policy or treated as a change in estimate? So obviously itself, yes, we are changing policies. That's okay. It's how do we treat it? Do we treat it as a change in policy or treat it as a change in estimate? So, at first glance, it appears to be a change in accounting policy, but if it is a change in estimate, what does that say? If it's a change in the pattern of benefits, okay? So pattern of benefits changes, then it would be a change in estimate. Okay, so those ones, we'll go through an example that has more specific stuff in that, but let's look at correction error in a prior period. So, errors, and the first year you work in accounting, you're definitely a lot of them. And they hopefully get fewer and further between, but they still happen. The big thing is you've got to correct them and fix them. So, errors in prior periods result from omissions or mistakes in financial statements caused by misuse or failure to use reliable information that existed at the time financial statements were prepared. So they can either be intentional or an oversight. Okay? So, just some things. You probably think of some errors you've made while you've been doing your homework, right? Who's made math errors? Definitely all of us. Invoice totaling, non-GAAP procedures. Okay, this especially with changes in IFRS, trying to keep up can be kind of crazy. Oh, wrong entries, and they can go on and on and on. Okay, also unrealistic estimates. So, for example, you take over a new job, okay? You get your new job and you're replacing the last controller or accounting manager or person in charge of the assets or whoever, and you look at how they have been depreciating the building. Well, they built a building a couple of years ago. They decided the life on the building was going to be 5 years. Is that realistic? No. So that would be an error. Okay? It wouldn't just be a change in estimate. It would be an actual error because someone who knew what they were doing would not have estimated something like that. Hopefully that makes sense. Between just a change in estimate where I thought the building was going to last, 45 years, when really it ended up lasting 55. We did the best we could with the info we had. That's far into the future. Whereas saying, oh, this building's only going to last 5 years, well, unless there's something wrong with your building, it's going to last more than 5 years. Okay? So, distinguishing between the correction of an error and a change in estimate can be, and you have to think, was the information overlooked, in which case it's an error, or do we have now more information? If an estimate was calculated incorrectly due to a lack of expertise, it's an error. If a careful estimate was made in the previous year and then later it's incorrect or needs to be changed, then it's a change in estimate. Okay? And again, are going to be retrospective, whereas estimates are prospective. And that's why we're differentiating. Okay, that's the of section A, and we'll leave it at that. Bye.